Hi, this is Joe Minton with Lightspeed Trading. I'd like to welcome you all to today's webinar, Getting Edge on Time Spreads, presented by Dan Passarelli, the author and president of Market Taker Mentoring. And I'd just like to make a quick disclosure that Dan is not associated with Lightspeed, and today's webinar is for informational purposes only. So at this point, I am going to go ahead and pass the mic to Dan and let him begin the presentation. Thank you all for attending. We appreciate your interest.
Hello everyone, this is Dan Passarelli. Hopefully you can hear me. If you can't hear me, that's a good thing. So welcome to our class today. Before we get started, I need to point out that options are not for everyone, and you should read characteristics and risks of standardized options before trading. Get a copy of that by calling 1-888-OPTIONS. So once again, my name is Dan Passarelli. I'm with Market Taker Mentoring. I'm the president and founder of Market Taker Mentoring. I've been in options over 20 years. Started down on the CBOE trading floor as a market maker a long time ago, and since then was able to write a couple of books on options. Trading Option Greeks is the one that perhaps many of you are familiar with. It's definitely the more popular one. And the Market Taker's Edge is the other one. And I'm sometimes on Bloomberg TV, been on Fox Business News, and that sort of thing. With me here is John Kasich. He's our head coach. He's a former Goldman Sachs guy. He's been in options even longer than me. You've probably read his articles online. He writes for a lot of financial media. John and I teach all over the country, all over the world. I've been in Canada, we were in China last year, we've been all over teaching options, and you guys don't even have to leave your house because we've got a nice little presentation here today that I think you guys are all going to love. Yeah, John is actually on his honeymoon right now, so yes. All right. Oh, one more thing before we get started. As a little thank you for attending our class today, we have an ebook. It's called 3 Secrets to Making Money in Any Market. And we'd like you to have it for free. It doesn't cost you anything. Just go to markettaker.com/3. That's markettaker.com/3. And you can read our ebook, 3 Secrets to Making Money in Any Market. This is, and Steve here is asking, is that the first, second, or third book? This is one of our ebooks. So I don't really count ebooks as books. You know, my actual hardcover books you can buy on Amazon. They're published. One's published by McGraw-Hill. The other is by Bloomberg Wiley. But this is a soft copy. It's a PDF ebook. Shorter than a typical book, but chock full of information. It's one that John actually helped me somewhat with, and we're really proud of. All right. So how many people here in class today are pretty experienced as option traders? So that's sort of a general question here, isn't it? Oh, a couple of you guys I know, like Kat here, she says not me, but I know better. Okay, so we've got a few of you guys who say they're experienced, but really only a handful. I'd say a small percentage, maybe 20%. Roger coming in with 15 years of experience. He's been around the block a couple times. All right. We just had some shy people who are commenting late. There's no need to be shy in this class, guys. But I am having a couple people here, like Terry, say not much options experience here. So here's what we are going to talk about today. We're going to talk about a somewhat more advanced topic. So if you've never heard of calls or puts or anything before, this might be a little bit over your head. but I'm a pretty patient guy, and if you have questions, even if they seem like really basic questions, feel free to ask. I'd be super happy to answer them for you. Okay. Part of what makes up the value of an option is volatility. All right? So volatility is something that I spend a lot of time talking to my students about. We, at Market Taker Mentoring here, we teach students online and in person, both in a one-on-one environment and a group environment. We spend a whole bunch of our time talking about volatility because it's so important to pricing options, A, and B, it's one of the trickiest parts to learning to become a better trader. And the reason why it's tricky is because there's two different types of volatility. And when you say, oh, well, let's look at the volatility, you know, you might not really know, well, which type of volatility are they talking about? So let me kind of break that down here for you. There's realized volatility and implied volatility. Now, realized volatility, which is also called historical volatility, is the volatility that you think of when you think of volatility. It's how much the underlying stock moves around, right? So like you look at a stock chart and the stock is whipping all over the place, kind of like we saw over the last 3 trading sessions here, 3 or 4 trading sessions here. The stock is really whipping around. Well, okay, that's realized volatility. The stock is experiencing a lot of realized volatility. That's measured by using the annualized standard deviation of the closing prices. Now then there's implied volatility. Implied volatility is kind of totally different, but kind of related. Implied volatility is how cheap or expensive an option is. Now at first glance you might say, well, what does volatility have to do with cheap or expensive? Like that kind of doesn't make sense. I don't know. Maybe the speakers got it wrong. Well, it is related, and it actually is kind of intuitive once you think about it. So what's the economic purpose for an option? Well, you can use them to hedge, right? When are you more likely to hedge? When are you more likely to buy puts to protect yourself or you know, use options as protection? Well, when you're afraid of volatility, right? So there is sort of correlation. When the market collectively expects a stock or the market in general to get more volatile, option prices tend to go up. So that's called implied volatility. Now, implied volatility is going to be the topic of the rest of our discussion here today. And I caught everybody up, hopefully gave you a little bit of a crash course on volatility. It sounds like many of you are already familiar with this, so I'm going to kind of kick it up a notch, as Emerald used to say, and take it to the next level, as video game players in the 80s used to say. Apparently they don't have levels in video games anymore. That's what my kid tells me. But who knew? A concept that uses implied volatility is the concept of skew. Skew is the observation that options on the same underlying, that's the same stock or ETF, may have different implied volatilities. So okay, just when you think you have it mastered, now we're kind of throwing this wrench in there. There's 2 types of skew. Vertical skew, which is the skew among different strike prices, and the term structure of volatility, or horizontal skew, or time skew, which is the different volatilities among different expirations. So you've actually probably seen this already. If you use Lightspeed Live Vol for Lightspeed, that's this platform here that all you Lightspeed traders have access to. You've probably seen this already. There's a column stated IV when you look at an option chain. IV is implied volatility. Now look at the call side. That's this side over here. Well, the 75.5 calls have a 23.5 volatility. 76 calls have a 23.4 volatility. 76 and a half have a 23.1, and so on and so on and so on. Each different strike price actually has a different implied volatility. Now there are a couple patterns that are important here. One is that the lower the strike price for calls, the lower the strike price, the higher the implied volatility, typically for most stocks. So we see these 75 calls have a 30 volatility, and then the volatility gets lower and lower and lower with each higher strike. So this is often called the slope of the skew. Here you see that every dollar strike we go up, implied volatility changes by 0.5%. But sometimes maybe a big put buyer comes into the market and they buy a lot of, maybe 75 or 76 puts or something. Well, because all the put strikes are interchangeable, if somebody buys one put, well, the implied volatilities of that put and also the puts surrounding it tend to go up. And so you might see something like this. This is when a downside skew is added. So here we're assuming a big put buyer comes in and the 75 puts go up to a 33 volatility, 76s are now a 32, 77s are a 31, and now it's a 1 point difference between the strikes. So the 79s only change by 1 point where the 75s change by 3 points. So there's a greater slope to the skew sometimes. So I used to be a market maker down on the floor of the Chicago Board Options Exchange. When I would see something like this, what I would do is I would be excited to sell the 75s and buy the 79s. Why? Because I'm buying one that's just maybe a teeny bit more expensive, but I'm selling one that's a lot more expensive. This is putting on a volatility spread. So that's what I did a lot of down on the trading floor. And now I'm going to show you the other thing I did down on the trading floor. I'm going to show you how you can use it in your own trading. This is the term structure of volatility, or the time skew. We're looking at just the at-the-monies here. These prices aren't current. This is an old screenshot. It's just for example purposes only. If I look at the 61 calls for all these different expirations, May 15th, May 22nd, May 29th, June 5th. Look, the May 15 61 calls have a 42 vol. The May 22nd 61 calls have a 37.5 implied volatility. And so on and so on and so on. It kind of changes here a little bit, doesn't it? So what is term structure volatility? It's simply this observation. So now let's look at a different way to look at it. On your live vol for Lightspeed platform, you can also kind of look up here and it kind of gives you a little bit of shortcut for looking at the term structure volatility. Now, having a shortcut is great. I personally like looking at the exact implied volatilities in the option chain because it's extremely important. Why is it extremely important? Well, look at a scenario like this. We're looking at different months here, so it's easier to say, basically. What if the May had a 34.6 vol, the June had a 29.1 vol, July's had a 28.4 vol, and October's had a 28 vol. So this is a scenario where the front month, or the short-term expiration, has a higher volatility than the back term. Now that's not always the case. Sometimes it's the other way around, where the shorter term expirations have a lower volatility. But when we see a situation like this, we might want to do the same thing I described with the vertical skew, whereas I buy the cheap one and I sell the expensive one. Now, who can tell me what kind of spread we're talking about here? or we're going to buy a July and sell a May. What is that called when we do that? Yes. Adel says a calendar. KC says a calendar. Matt, you're close. Calendar. Or, like Roger says, a time spread. Right. Time spread and calendar spread are synonyms. You can say either. They mean exactly the same thing. That's because you're buying one option that expires at one time and selling an option that expires at a different time, a different date on the calendar, if you will. But when we trade time spreads as retail traders, we're typically buying the long-term, selling the short-term. Otherwise, it can get tricky with margin requirements and that sort of thing. So this gives us an opportunity here to buy a cheap call and sell an expensive call. Put on a calendar spread for an edge. Now, that might seem like maybe either at worst, at best an esoteric statement, at worst kind of a load of BS. Well, what do you mean buy a cheap one and sell an expensive one? That's not the option's price. That doesn't tell me if I'm going to make money. Why does that really matter? Well, I'm going to explain that in just a moment. As a professional trader, my job was always to make a couple of volatility points. Professional option traders are volatility traders. We're not buying calls and guessing that the stock is going to go up. It's not what we do. Or puts. You know, we're not selling puts because we think we're going to skate and not get assigned. We do spreads like I'm describing, and it's all looking at the volatility spreads. Now, for those of you who are familiar with the Greeks, when implied volatility changes, how do you actually make money? Well, you make money on Vega. Your profit on as a volatility trader is the volatility move, how much the implied volatility changes, times the options Vega times the number of contracts. Now, Vegas are typically a couple pennies of option premium. Each penny is $1. So per contract, we're talking, you know, literally for a professional trader, your goal is to make a couple of dollars. And I'm not saying a couple of dollars like a couple thousand. I'm saying literally $2 or $3 a contract is what my goal was as a professional trader. So I wasn't happy trading one lots. I mean, you had to trade a lot to make, you know, $2 or $3 add up. You have to trade thousands and thousands and thousands of contracts to make any real money. Now, okay, here's the rub. Here's sort of the line in the sand. Yeah, that's all fine and good that professional traders are volatility traders, but you guys have a hard time trading like that. Your goal, I mean, whose goal here in this class, who has the goal to make $2 on every one of your trade, like 2 cents of option premium? Who has that goal? Anybody? Who's happy with that? They're like smiling, going to the bank, cashing their check for $2 that they made on their last trade. After commissions and taxes and all that business, it's about 77 cents or something like that. Yeah. So like Tony says, it's not enough to cover commissions and, you know, the bid-ask spread and taxes. GM says he's happy. Okay. Well, good for you, GM. Good for you, man. So here's the deal. How can you, as a non-professional trader who needs to make more on each trade, you know, you need to make 20 cents, 50 cents, $1, $3 on your trades to make it worth it to you. What does this volatility stuff really matter to you? It's extremely important for you, and so is the skew. If you trade a spread, you are trading skew. So, if you're trading it, you should try and profit from it. Time spread results are always improved by term structure of volatility and using it to your advantage. So you should So you should use volatility as a screen for any time spread candidates. So let me show you how you can do that here. Okay. Let's say you are looking at this stock. What is this? Facebook, not current prices at all. It's probably from a year ago or so, just for example purposes only. But it was a really good example, so I'm using it. You can actually probably find a couple of really good examples these days too, but let's imagine we're looking at the term structure of volatility, and we see that the February 14th 66 calls have a 46 vol, and then the week later 66 calls have a 30, basically a 36 vol. 10-point difference. 10 points apart. What can I do with this information? Well, I can do a lot with this information. I can consider a time spread. Now, I will say that volatility term structure is not the only important thing in trading a time spread. I also want to make sure that the stock, is in a range, and I think it's going to remain in a range during the life of the trade. Right? I want to make sure that the bid-ask spreads are not too wide. I want to make sure that the theta disparity is high enough, blah, blah, blah. There's a lot of different things you look for in time spreads. But if I use volatility as a screen to say I'm only going to trade it if I see a higher volatility in the front, well, here's what happens. With the skew, I can buy this spread at 71 cents. Okay, so let's take a look at that. So that means I can buy the February 22nd calls at $1.94, sell the February 14th at $1.23. That's 71 cents, right? 194 minus 123 is 71 cents. But what if there wasn't a skew? Now, the shorter term expiration volatility moves more. So if there wasn't a skew, probably the shorter term expiration would be the same as the longer term expiration. So this wouldn't be 46, it'd be 36. What if it was? What if it wasn't 46, it was 36? How much would this spread cost? Well, the February calls would be a $1.10 bid instead of a $1.23 bid. All right, now those of you who are kind of novice to options, you might be scratching your head saying, what's he talking about? How does he know that? Well, it's simple. If implied volatility was 10 points lower, that would make our option prices lower by the amount of vega times 10 points. So the vega happens to be $1.28 or 1.3 cents of option premium to round it. 1.28 cents of option premium around it. So if implied volatility is 10 points lower, our option price would be about what? 13 cents less, right? If it's 1.3 cents per contract of vega for 10 points, that's 13 cents less. So this wouldn't be a $1.23 bid, it would be a $1.10 bid. Now, the February 22nds wouldn't necessarily change. So I can pay $1.94 for these, sell these at $1.10. Oh wait, I'm paying more actually now. I'm paying 84 cents or 83 cents. I kind of rounded, back and forth a little here. Spread would cost roughly about 83 cents. So hold on a second. It's the same time spread. The stock chart doesn't change. It's still in a range or not in a range or whatever it is. Still no news or no earnings out. But because this mystical thing volatility changes in the short-term calls that we would be selling, it changes the value of my spread. Now, why that's important should actually be pretty intuitive. If I pay 83 cents, the most I can lose is 83 cents. Well, that's not nearly as good as if I pay 71 cents, the most I can lose is 71 cents. My trade is actually worse if there's no volatility skew. It's way better with volatility skew. And in fact, my maximum gain is better when there's this volatility skew. I couldn't make as much when there's no skew. My break-evens on a time spread are more in my favor when there's volatility skew. When we don't have this term structure volatility in there helping us out, we have a worse trade all around. So look, you guys are going to make money on trades, you're going to lose money on trades. You trade enough, you're going to have hundreds, maybe thousands of winners, hundreds, maybe thousands of losers. Nobody makes money on everything they trade. That's it. Life just doesn't work that way. So let me ask you this. What if your losers could be smaller and your winners could be bigger on every single trade you make? How about that? Do you think you would make more money in the long run? Well, by definition, you would make more money in the long run because you lose less on all your losers, you make more on all your winners, you make more money in the long run. Now here, this is a difference of 12 cents of option premium. It's $12 of cash. Maybe you typically trade a 10 lot. That's $120 of money that you're going to either not lose if you lose, or you're going to make on top of what you would otherwise trade if you weren't looking at this. 120 bucks of edge. This is real money. I mean, I'm showing you the math. This is how this works. And on top of this, you're setting yourself up for a shorter term profit and not hold this into a longer period of risk. Because with time spreads, you typically have to collect on theta, right? You have to wait for time pass and make money on theta. But these vols in this particular case should not be that disparate. There wasn't earnings coming out, there wasn't anything like that. And so if they shouldn't be different, then that front month volatility should fall. And the ones I sold here should go from 123 to 110. Obviously, as the underlying stock changes, you know, there's a delta involved, but it's involved with both, and the delta is roughly the same for both of the trades, so it's fine. But if this volatility fell, I could make that 12 cents now. That's about a half a day's worth of theta in my pocket now. So I can profit in a shorter period of time, potentially, when there's a volatility skew involved. Kat says, Dan, please talk about your range of skew that you're looking for. So I like to see a difference of I want to see the shorter term expiration be at least 2 volatility points higher than the longer term, but no more than 20 points higher. Why no more than 20 points higher? Because you'll very often see term structure volatility like this when earnings is coming out. We still don't want to trade this going into earnings. We still don't want to have any volatility events. We don't want to be trading it going into the Brexit, for example. So we're looking for anomalies. Usually if there's a huge skew, then that means maybe there's something that we didn't see in the news. Matt says, how often do you see a good volatility disparity on ideal sideways plays? Well, you're always going to see it on false positives. You're always going to see it, not always, but usually going to see it when earnings is coming. You don't want to trade those. Even if there is, I'm not saying if there's a vol disparity, always trade it. I'm saying if there's a vol disparity and it's an otherwise good time spread, now you found a great time spread. So when do you see it when there's not earnings? On a somewhat regular basis. I mean, I could probably spend 30 minutes and find 5 of these. You know, I mean, you can use the LiveVol platform here and do a scan for it. You know, I mean, there's a number of tools. Matt also says 2 points on close, shorter term weeklies. Well, 2 points, you look at this anytime during the day. You know, implied volatility, this updates all day long. So anytime you look at it, like close as in tight together. Yeah, 2 points is as tight together as I want. I want more than 2 points, but less than 20 points. And and as far as weeklies, yeah, so you know, someone asking, you know, I'm paraphrasing here, but do I always want to do time spreads 1 week apart? No, not always. Sometimes I'll do 2 weeks apart. I mean, here if I went out to the February 28th, it'd actually be a higher volatility, so arguably not as good. You know, sometimes I'll do 1 week apart, sometimes 2, sometimes 3, sometimes a couple months apart. I've done it that way. So, you know, again, all the things that we care about in time spreads also apply. We're looking for range-bound stocks because we have gamma risk. Avoid earnings and other volatility events. Sometimes if volatility is high, it's high for a reason, and it's a warning sign. We're looking for the anomaly, the needle in a haystack, if you will. So, yeah, this was, you know, again, prices are not current here, but this is just another screenshot. I just started tooling around a little bit the day I was putting together this presentation. I was like, oh, well, here's another one in Schlumberger. Oh, here's another one in Aetna. You know, they're not hard to find. You know, I mean, look, Aetna was in a nice little tight range. Earnings was already out like 2 weeks prior. You know, this is a beautiful freaking time spread setup. So vertical spreads, you can use Skew too. That's out of the scope of what we're going to talk about today, but we're going to have a Q&A session coming up in just a few, so feel free. I'll entertain questions about vertical spreads as well. But another thing, you know, you have to look at the Vegas. If the Vegas are really small, Skew doesn't help you quite as much. So like if we're looking at like 2-day options, time spreads are still not really spectacular. The bid-ask spreads need to be pretty tight because if the bid-ask spreads are really wide, we're selling much lower than the midpoint, buying much higher than the midpoint. You know, you can try and middle the markets, but the implied volatility figures aren't as accurate if the bid-ask spreads are wide, so you always want to keep nice tight spreads. We are going to do Q&A in a second, but I wanted to run a couple things by you. First, don't forget that ebook, 3 Secrets to Making Money in Any Market. John and I wrote this together. I think it's our best ebook. Again, different than my books that are on Amazon, but really high quality, I think. We're proud of it anyway. We worked real hard on it. And you'll get something out of it. Even if you're a pretty experienced trader, you'll get something out of it. Before our Q&A, and you guys can start sending in questions right now. Before our Q&A, you know, we had somebody asked about how often you find them. Somebody else asked something about like how do you scan for them or something. Where can you get trade ideas like this? Well, how would you like all the trade ideas you need without having to scour the market to find them? What if somebody did the work for you? What if somebody who's been in options for 25 years, who used to work for Goldman Sachs, is finding trade ideas for you every single day? Well, we actually have a program like that. It's called our Market Taker Live Advantage group coaching class. Classes are every day for an hour. They start at 9 a.m. Central, half hour after the market opens. It's 10 a.m. Eastern. And John shows you trade setups every day. He walks you through it. It's designed to kind of be earn while you learn. He shows you how to do it, but he's also giving you the trade ideas. So it's the best of both worlds. Teach a man to fish, give a man to fish. We're doing both. He gives you around 10 trade ideas every day. The classes are recorded. If this time is not good for you, about half the people who are in this class don't even show up for the live class. They just watch the recordings, I guess. And we're going to give you a special bonus today. It's called Exiting Options for Maximum Profit. And I'm giving this to you for like more than half price. You're going to love this in a second. But the bonus is a 1-hour video class, 3 months of unlimited access to it, and it's everything you need to know about exiting options for maximum profit. Where do I set my trailing stops? Where do I put my target price? You know, do I use support and resistance? So here you go, guys. Look, here's what this is. Our normal price for the group coaching is $997 per quarter every 3 months. At first you might think, well, that's $1,000. It's kind of a lot. If you could pay $1,000 and get 10 trade ideas every day from a former Goldman Sachs guy, I mean, how much do you think you could make off that $1,000 investment? If you just took one of his trade ideas every week for 13 weeks, could you make $500 off each trade idea? I mean, could you make $200? Could you make $1,000? Depends how big you trade. So it's a great investment at $997 per quarter. But we're throwing in a $200 bonus, and we're giving it to you for only $500, $497 right now, today only. And if you want to save a little bit more, you can sign up for 6 months for only $747. That's a $1,900 value for enrolling today. Now, does anybody have any questions about this class or anything we covered here in the webinar? Yeah, you get access to the live classes and the recordings for the entire 3-month period. We have, you know, our normal price, what we sell it on the website, is for $1,000 access, and people are clamoring to pay that because it's a great investment. We're throwing in our bonus video on how to exit trades. That's a $1,200 value, and we're giving it to you today right now for $497. All you do is go to markettaker.com/3MO. That's 3 months. Or again, if you want to save a little extra money, go to markettaker.com/6MO. That's for 6 months. Matt asks, is the trading style all implied volatility based trading? Well, Matt, yes and no. I mean, all option trading actually does have an implied volatility component to it. If you look at any option trade you have on now, are thinking about making, or have ever made in your life, they all have a vega position. That means they all have exposure to implied volatility. When implied volatility goes up or down, you're actually making or losing money as a result of implied volatility going up or down. Now, a lot of people don't even think about it. They don't even know. They just say, what? How come my call's worth a different price? It shouldn't be. How come the stock went up and my call went down? It's not supposed to work like that. Are the market makers ripping me off? No, it's because implied volatility changed. So for some people, it's just a mystery to them. You guys who are putting in the time here to learn and try and become better traders, you know better. You know that, hey, if the stock goes up, if implied volatility falls, my call might go down. So yeah, all the trades we talk about have a volatility component, and part of our analysis is based on implied volatility. Yes, I mean, it has to be. Otherwise, you know, it's just amateur trading, and you're just kind of guessing. So we're looking at this really scientifically. I mean, John's the head coach. He leads the class. He's been doing this for over 25 years. He's an ex-Goldman Sachs guy. He also worked with First Options of Chicago. You know, he knows what to look for, and he has a very scientific approach to finding trades. But he's also a really friendly guy too. You'll love learning from him. He's really good at explaining things, breaking things down, and making them sound simple. It's a really, really great class. Do we have any other questions, again, about this really special offer, or about any topics we covered in the class? Oh, yeah. We have a question on vertical spreads and IV. So whenever there's skew, there's opportunity. Whenever there is skew, there is opportunity. And so when the vertical spread skew drastically changes, there might be an opportunity to put on a high probability vertical spread. Now, when you put on, like, put debit spreads or call credit spreads, there's inherently a slight advantage. Usually it's such an unnoticeable advantage that I don't even tell people to look too hard for it. But remember, the lower strikes are always higher. So if you're buying higher strikes and selling lower strikes, you have a slight volatility advantage. Now again, usually it's so small that it barely matters unless there's been a lot of downside put buying, and then you can put on, you know, maybe a nice spread. But again, that deserves a much longer explanation than we have time for in the Q&A section, because I think Joe and the rest of the gang are going to kick me off here if I start going into a 15-minute explanation. Frank says, do you teach what expiration dates to choose? Yeah, that's like the big thing in this class, because you know, you might look at a chart and say, well, yeah, you know, I'm bullish here, or I'm neutral here, or I'm bearish here. I want to buy a call or put on an iron condor or a time spread or blah, blah, or, you know, buy a put spread. But what strikes do I choose? What expiration do I choose? That's the advantage, is John opens up his live vol trading platform and he shows you the setups step by step and explains them. He'll say, here, look at this chart. I'm looking at this support level and this resistance level. Because that, I would buy this strike and I would sell this strike. My time horizon is this, and there's a better term structure if I put on this expiration cycle. So you're going to learn a ton, but it's designed to be earned while you learn, and you're going to have trade ideas fed to you every day that are really clearly explained. Some people sign up for the class just to get and trade the trade ideas and try and make money from those. Some people sign up for the class just to be in the head of a former Goldman guy. Adel says, do you beta weight Vega? You may have several positions open all at different underlyings. Well, beta weighting is typically for deltas. And, you know, beta is how much the underlying moves with the S&P 500, or whatever index you choose, but typically the S&P 500. You know, with Vega, it's not how much the underlying moves, you know, so it's kind of something very different. You know, what makes up different Vegas is more sort of how high the volatility is. If it's a $10 stock or a $1,000 stock, you know, the Vegas will be drastically different. How much time is left till expiration? So no, not really beta weighting Vega, but I mean, I do take into account disparities based on other things. Joe, maybe you got Tony's question. You probably explain it better than I could. I don't know. Adel says, right, but implied volatility times Vega doesn't work well with multiple positions. Well, yes and no, Adel. And I hope I'm pronouncing that right. Yes and no. Oh, good. I thought so, but I wasn't sure. So let's say I have, let's say I buy some calls on, you know, Priceline, you know, or Google, or just say $1,000 stock. Those are going to have really big Vegas. Maybe I buy a 10 lot and I get $400 worth of Vega on my 10 lot. But then I buy a 10 lot of something like Ford Motor Company, or let's just say a $10 stock. And I get $40 worth of Vega on that 10 lot. So a total of $440. Well, if the VIX goes up 10 points, you know, I mean, there's not really a beta calculation for how much it acts like the VIX or anything, but conceptually, you know, there is. See a cat. Well, then you're going to make, or you know, you're going to make a lot on the $1,000 stock because it has bigger Vegas, and a little bit on the $10 stock because it has smaller Vegas. You don't necessarily need like that sort of beta weighting because it's basically just a smaller position in the $10 stock. It's just a smaller Vega position. I mean, you can normalize it by, doing it 100 lots of the $10 stock versus your 10 lot of the $1,000 stock or whatever. Just throwing out numbers here. So, I mean, yeah, it kind of works different. I mean, I appreciate where you're going with this. I get it. He says, you could be net long Vega and IV is up and you still lose. Well, yeah, that's true because if, maybe earnings comes out on the $1,000 stock and implied volatility gets crushed, but the VIX goes up and so you make on the $10 stocks little Vegas and lose on the $1,000 stocks big Vegas, yeah, sure. You're right. But so it's good to look at, I mean, that's why it's not really perfect. And it's not perfect with beta weighting either. I mean, the S&P 500 could go up and one of the stocks you're long could go down and you could lose on that. So, yeah. So, anyway. So there's that. Teresa says, on time skew, do you look at week by week for at least 2 points on IV or month by month, every 2 weeks IV points? Well, Teresa, there's a number of factors there that matter. One is, what's my time horizon? I mean, what I like to do sometimes is, if I think a stock's going to be in a range for 6 weeks and it has weeklies, I might buy a 6-week option and sell a 1-week option if the term structure skew is there. And then I'll just roll on expiration day week after week after week, and that can be an awesome strategy because you're selling really high theta options against low theta options. So, that's one factor. Another one is, well, where do I get the best skew? The one example, doing 1 week apart gave me a better skew than 2 weeks apart. I mean, usually it's consecutively lower or consecutively higher vols the further out you go, but sometimes it's not. So I'll look for where the better skew is. If they don't have weeklies, month by month is fine. So, it's science, but it's also art, All right. Any final questions? Once more, just to make this easy, markettaker.com/3MO, markettaker.com/6MO. This is going to be your last chance to join in and be part of our class. If you enroll today, you're going to be in class tomorrow morning at 9 o'clock Central Time with John, and he's going to be giving you trade ideas and showing you live market setups. Matt says, I guess this wouldn't work for a butterfly. Well, butterflies are different, I was going to say different animals, but I guess they're insects. They have very, very small Vegas, especially when there's more than a couple weeks to expiration. I mean, butterflies you typically only trade with less than 2 weeks to expiration. A little free tip there for you. And then that's when the Vegas and Thetas can really start getting disparate if you're sitting right at the money. Yeah, I mean, I don't know. Yeah, it also says Vegas 0 at expiration. But, the deal with butterflies, if you're selling 2-week options or 1-week options, if you're right at the money, you will have you'll have a Vega for a couple weeks. Obviously it goes to 0, but for a couple weeks you'll have a Vega. Roger says, do you ever go in and out of the short option? No, man, that's, don't do that, man. Because you know what? That's market timing voodoo, and you're losing on the bid-ask spread every time you go in and out. Can you middle the market? Yes, but if you're middle in a single leg option, you typically only end up trading if the market moves against you and you end up buying the bid or selling the offer anyway. You just don't realize it. And you're going to be wrong plenty of times. I mean, look, man, I was a trader for a long, long time down the trading floor. I don't even know how many trades, 100,000 trades maybe, I don't even know. You're going to be wrong plenty of times, and it's just not worth it. Just put on the time spread, because time spreads are going to have lower risk than trying to guess directionally. Like trading directionally is way more random, way more difficult than trading when you have an edge there. Seeing that, oh, I'm actually buying a lower vol than I'm selling. I'm actually locking in this $12 per contract. You know, win, lose, or draw, that $12 is still mine. Trade the sure thing. You know, don't gamble. Be the casino. All right. One more question. Edel says, as market maker, did you get to buy the bid and sell the ask? Yes, sir, Bob. That was the big advantage I had. That and being smart about volatility. Those were the only two advantages I had. Yeah. So, all right. Oh yeah, the bonus is exiting options for maximum profit. This is worth the price of admission almost already. It's a $200 class, hour-long video you get 3 months access to. It is everything you need to know about exiting options for maximum profit and minimal loss. That's I get really great feedback on that class. But, you know, for $500, getting 3 months worth of trade ideas from John every day, it's worth it. It's worth at least trying. I mean, think about what'd you pay for the last trade you made? You bought a call for $500? That was way more of a gamble than this. This is a great investment in your trading future. Anyway, this is Dan Passarelli. Follow me on Twitter, twitter.com/Dan_Passarelli. I'm glad you could join me. Thank you all for attending. Great to meet you. I hope I helped you guys with your trading. Have a great day. See you later.